I think, see, it's first and foremost important to understand where a large amount of capital went into fintech as well. If you actually looked at the fintech trends and break it up by sector, sectors that were involved in lending or credit actually raised the largest amount of cash. The reason why they did that is, number one, capital for them is inventory. The more the cash they have in the balance sheet, the more they can end up lending, the greater the leverage they can take, and the more they can end up actually circling that amount of money. That's number one. Number two, also, a number of lending companies unfortunately did not build up strong liability franchises, because of which they would raise equity capital for what? Equity capital in lieu of a liability franchise, which means they would raise equity, end up actually lending that equity out, as opposed to raising debt capital from the markets and actually lending that out as well. That's number two. Number three as well, a large number of these companies actually had holes in their balance sheets which they had to fill through equity. And the moment that equity tapped actually dried out, because these companies weren't profitable, we actually saw these companies end up actually dying. Now, if you start looking at fintech as of now, lending is the funding into lending is actually at an all-time low. We are seeing a lot more funding happen either at the late stage growth PE stage, but in early stage, mid-market stage, etc., the money has actually dried up, because I think the ability of these companies to end up actually winning against the incumbents is actually reducing. The incumbents are putting a lot more money into technology and buying the same sort of systems and technology and underwriting that these smaller companies and startups ended up actually having, number two. And number three, because of the strong regulatory changes that have happened, the regulatory lacunae and the gaps in interpretation that used to exist, all of them have been rather viciously removed by the RBI as well. So we have actually seen this sort of level playing field occur now between technology-led lending companies, NBFCs, and banks also for that matter. And I think if you notice, even when it comes to gold loans, when it comes to personal loans, when it comes to any of this, the RBI has very strong regulatory interventions to all these markets as well. So that being said, one of the greatest drivers of funding into fintech have actually gone away for that matter, but the substitution effect we'll see as of now is that a lot more money is going into other areas. It's going into wealth management, it's going into asset management, it's going into stockbroking apps, it's going to even fintech infra as well. So we may not see the large amount of capital raised, but the reasons for why that we may not reach a high watermark also have to be understood and internalized by the market as well. So when you speak about fintech numbers, I wouldn't say looking at someone raising 200, 300 million, look at why they had to raise 200, 300 million. Are they raising it for the purpose of growth? Were they a profitable business? Or were they raising it purely because they had to raise, otherwise they were running out of runway? And I think the companies we're going to see end up coming to the market as of now, especially in fintech infra, especially in the credit, not in credit space, but credit enablement space, underwriting, debt collection and resolution. They may not raise as much money, but they'll become far stronger financial institutions with far healthier balance sheets compared to what we've actually seen in the past. I think fintechs have failed to understand why this particular sector has fallen out of favor. I think a number of people are trying to repackage old wine in a new bottle, for that matter, or slap a layer of AI onto it and believe they're actually fundamentally different. See, if you look at fintech, financial services, all of fintech comes under regulated financial services. Regulation is 1/3 of your name and nearly half of your pain. But how many of these fintech companies actually have in-house regulatory expertise? Very few of them. How many of them have actually been taken by surprise that some sort of change is actually happening? Nearly all of them. The level of maturity that was supposed to be there hasn't come in. Everyone believes fintech is a tech problem. It's not a tech problem. It's a regulatory problem. It's very easy to end up actually borrowing at X and lending at 1.5x. People have been doing this ever since the concept of money actually existed. Technology is an enabler for that. But what we have seen a number of fintechs actually do in lending especially is that they would have terrible underwriting practices. They would all believe that their tech is actually superior without understanding the gaps that actually existed. It's been fairly well known that because your credit scores end up getting dinged above a certain value, a number of people would take loans just below that threshold. Take loans from multiple people, so even when they defaulted, it never actually reached the credit bureau, so people wouldn't actually know about it. That's a failure of the market mechanism. How many of the fintechs have actually solved for that? Very few. I think what's important for fintech also, that's number one. Number two, a large amount of fintech companies would actually burn money like consumer companies. They put a large amount of cash into marketing, give like cashbacks for taking a loan, and all these sort of absurd kind of practices. This may work for an Uber, it may work for a Flipkart, it may work for any of these companies who are a Mama Earth and others. It doesn't work when it comes to financial services. The third part, I think, is also this false expectations of fintech founders who genuinely believed that they have to grow 100%, 300% year on year. I think they actually failed to understand the power of compounding. In financial services, if you grow even 30% year on year, it's a fantastic rate of growth. because over time you'll be able to compound so aggressively that you don't have to end up actually growing at these absurd kind of rates. So this entire grow at all costs playbook, hacker playbook, and these other kinds of nonsensical things that ended up actually becoming part of the fintech playbook, fintech lexicon, are very unfortunate. And even now, as founders come back with these same kind of tropes and try to slap a layer of AI onto that and say, I'm different, they're not. Smarter fintech investors can actually sniff this out, which is why fintech investors have become a lot more judicious about who they end up funding. They may not give them as much capital initially, but the moment these companies end up breaking out and prove that they are different compared to the crop we've seen in the past, there's a large amount of money that's actually waiting for them. No, sure. So see, like I said, the reason why these companies raise capital is also important. For all the companies that raise capital to fill a hole in their balance sheet, I don't think the investors are going to see any amount of money actually coming back. Even when it comes to lending as well, it's fairly easy to lend. It's really hard to actually recover that cash. And if you think about it, and look at the entire fintech landscape as of now, how many startups are actually there in debt recovery and debt collection? Very few. How many companies are actually there in credit? Very large. How have the NPAs actually been? Fairly large. A large number of these would actually write off their NPAs because they would raise capital. That capital went to subsidize the inefficiency of their lending and collection process. And that is why that money will never end up coming back, number one. Number two, if you look at even payments, I think for all, I mean, UPI is a fantastic product, but the MDR issue still actually looms high amongst all of them. So for them, they would end up paying a large amount of money to actually give cashbacks for this. In fact, my college experience was actually subsidized by the large amount of cashbacks over there. There were about 35 wallet companies. I actually had an account in all of them, and whoever gave me the highest cashback, who I went to. How many of those wallet companies actually exist as of now? Even the ones that exist have moved away from their wallet services and actually gravitated towards other areas. So it depends on, while it was a very seductive idea, every Indian's getting a smartphone now. You have UPI, you have Jandan, you have Aadhaar, they have a bank account. Let's get into credit involvement. But they fail to actually build a viable business model out of that. That money is never coming back. So I think the important part in fintech also as of now is to look at the quality of spend and why these companies end up raising cash. If you're running an insurance company, for example, you need to raise 100 crores minimum to end up actually doing that. It's a matter of fact, it's needed. If you want to build a mutual fund AMC, your net worth has to be anywhere between 50 to 150 crores, depending on your size, your stage, how long you've been around, etc. That being said, those kind of businesses require that kind of cash. For some of the other ones like payment, etc., where they would raise the money purely for the purpose of subsidizing their consumers, that money is never coming back. So I think fintech also, smarter fintech founders have learned this. They become a lot more judicious about how they present themselves. They become a lot more judicious about how they spend their money, where they end up allocating capital. But I think the crop of fintech founders, there's still a large chunk of fintech founders who haven't learned these lessons. And even investors who are sick of seeing their money basically follow the song Hotel California. You can check in anytime, it's impossible to check out. These kind of investors aren't going to fund them. They're sick of the money going into consumer subsidy without any chance of it actually delivering a financial return. That's why the numbers have actually dipped, and that's why some of this money may never come back. I think a fantastic step forward. First off, I mean, they would have had their reasons for actually leaving the country, for that matter, and you could, of course, debate it. It's a decision made as of a particular point in time when the regulations were different. But I think when it comes to financial services also, regulators get a lot more comfort when the headquarters is actually directly regulated by them as opposed to trying to regulate a subsidiary, number one. Number two, also for that matter, it makes business sense to have your headquarters close to where your management team sits, where the majority of your market actually lies, and where your regulator is actually housed. So I think that's also a reason why they've ended up actually coming back. The third part also is that some of the issues that existed at a point in time with regard to funding, with regard to regulations, etc. I'm talking about corporate regulation, not fintech regulations or the other financial services regulations. A large number of those have actually been eased. So thereby the reason for them to end up actually remaining overseas has actually gone away. Lastly, I think if you look at in the year 2024, India saw more tech IPOs than the NASDAQ did. How many people are actually speaking about that? Goes to show that, and for the amount of money these companies have actually burnt in terms of marketing, they are household names in India. But the moment they choose to list overseas, they've actually divorced themselves from the entire Indian market. No mutual fund can buy them. The mutual fund allowance to buy overseas assets is about 7 billion, and that gets played out very, very quickly. Most people can't use their LRS to end up actually buying the stock. They can't buy it through a Dhan or Zerodha or any of these other stockbroking apps. So therefore, they realize that because their market's in India, their customers are in India, a large amount of the investors are going to be in India. And for them, if they do an IPO in India, they will get a lot more media attention compared to the US or Singapore or wherever they were. It does make a lot of sense financially, business-wise, market-wise, marketing-wise, recall-wise to end up actually shifting domicile. And we are seeing this happen not just in financial services, we're also seeing this happen across. And of course, I think the Indian regulators get a lot more comfort having the headquarters actually governed here. And that has obviously played a very strong role and influenced their decision to actually move back to the country.